All right, let's get right into it. Welcome to today's Explainer, where we are dissecting a seriously high-stakes corporate puzzle. Now, we aren't just looking at a clothing company today. We are literally unraveling a business thriller. We're going to examine the H&M inventory crisis to figure out exactly what happens when one of the biggest fast fashion retailers on the planet faces a total, catastrophic breakdown in demand forecasting. I mean, just think about the sheer scale here for a second. We are talking thousands of stores, tens of thousands of employees, and billions of dollars on the line. It's a crazy story about massive speed, global scale, and the absolutely terrifying financial risk of building a worldwide empire on something as fickle as a trend.
So, let me ask you something. Can you predict the future? I know, it sounds like a loaded question, but at its core, fast fashion depends on this one critical, almost impossible capability. You have to predict what millions of completely different customers will want to wear long before they actually buy it. What's so fascinating to me is that this industry isn't really about fabric or thread or sewing machines at all. Right behind those bright store windows, it's basically a dangerous, multi-billion-dollar casino game of predicting human behavior. And as H&M found out the hard way, guessing the future of human taste is much, much harder than it sounds.
In fast fashion, there's this constant, unforgiving ticking clock. Speed is absolutely everything. Because if your forecast is wrong, the entire system collapses and products lose their value at lightning speed. Think about it like this. Imagine a bright neon pink summer jacket. In June, that might be a viral, must-have item that sells out instantly. But by late August, it's completely dead weight. It's not like selling hammers or nails that can just sit on a hardware store shelf for 5 years without changing. In this industry, forecasting mistakes spread through the entire business model incredibly fast, turning what was a well-oiled retail machine into a massive, suffocating financial liability.
Section 1. The Fast Fashion Empire.
To really understand the collapse, we first have to set the stage and look at our powerful protagonist, H&M, before its inevitable stumble. For years, their business model worked like absolute magic. They built this global retail juggernaut around the really specific, high-volume strategy. You have affordable pricing combined with trend responsiveness, which basically meant everyday customers could suddenly get runway-inspired clothes at a fraction of the cost. Then you add in global sourcing, so using massive international supply chains to keep those costs dirt cheap, and rapid product turnover. That turnover kept shoppers coming back to the mall week after week just to see what was new. It created an unbelievable system of high sales volume and rapid international expansion. But, and here's the catch, this exact formula also created an immense hidden operational pressure.
Section 2. Predicting the unpredictable. The whole system we just talked about has a fatal flaw baked right into its design. It relies heavily on moving mountains of inventory quickly, and crucially, forecasting consumer preferences correctly. You see, fashion forecasting isn't just about predicting how many plain white t-shirts you're going to sell. It is entirely about predicting taste. And that leads to a brutal clash of two totally different worlds. On one side, you have production costs. Factories, shipping containers, manufacturing logistics. These are concrete, heavy, fixed, and known. On the exact opposite side, you have consumer taste. Taste changes in a blink. Actually, scratch that. It changes faster than a blink on TikTok. It's driven by wild swings in social media, sudden celebrity influence, weird weather patterns, and completely unpredictable cultural movements. You're trying to align a massive, heavy, physical supply chain with the most ethereal, chaotic metric imaginable, human desire.
This creates a genuinely terrifying reality for retailers. Retailers must make production decisions months before customers actually purchase products. This essentially means H&M and companies like it are throwing darts in a pitch-black room. They are forced to place multi-million-dollar bets based on pure forecasts, with zero certainty. They are operating completely in the dark, committing to fabrics, colors, and cuts half a year in advance. They just have to hold their breath and hope that when the cargo ships finally arrive and the clothes hit the store floors, the trend that inspired them hasn't already died out.
Section 3. The Dangerous Inventory Trap.
So what happens when those forecasts are inevitably wrong? When the company predicts a trend that totally flops, or they vastly overestimate the demand for a particular style, we reach the real climax of our story. H&M eventually faced rising inventory levels across huge parts of its business, and this triggered a total logistical nightmare known as the snowball effect. It goes like this. First, the warehouses start filling up with clothes nobody wants, meaning storage and operational costs immediately skyrocket. Second, because those products aren't moving, all the cash used to manufacture them gets trapped inside that unsold inventory. You can't pay your staff or design new clothes with a pile of unsold sweaters. Third, out of pure desperation to free up space and cash, the company starts aggressive discounting. And fourth, that rapid discounting entirely eviscerates profit margins, leaving the whole business financially weakened and unable to adapt.
Excess inventory in this specific industry is a totally unique beast. It's defined as unsold, time-sensitive products that rapidly transition from a profitable asset into a dangerous financial liability. Just try to imagine the physical reality of this for a second. Enormous warehouses literally bursting at the seams, aisles upon aisles of cardboard boxes taking up incredibly expensive real estate. And inside those boxes are garments that literally lose financial value every single morning the sun comes up. In fashion, yesterday's trend is not just out of style, it is today's financial deadweight pulling the entire company down.
Section 4. Rise of digital rivals.
Now, as if the internal pressure of choking warehouses wasn't bad enough, right when H&M was grappling with all these inventory pileups, a new antagonist entered the scene, and the whole playing field shifted. Agile, digital-first retailers, the ultra-fast fashion brands, completely rewrote the rules of the game. Traditional retail forecasting relies on a slower, season-based calendar. But these new digital rivals, they bypass traditional forecasting entirely. They started weaponizing huge amounts of real-time customer data and algorithms to scrape social media, identify a microtrend, manufacture it in tiny batches, and get it online in a matter of days. And if it sells, they make more instantly. Suddenly, H&M was playing slow, methodical chess, while highly responsive online retailers were playing a lightning-fast video game with direct visibility into exactly what customers wanted at that exact second.
Section 5. The markdown threat.
Facing these much slower operational speeds and massive mountains of mounting stock, traditional retailers have to resort to really desperate tactics to clear out that inventory trap. When your warehouses are stuffed to the brim and your digital competitors are moving 3 times faster than you pull the emergency lever. You slash prices. Now sure, a markdown clears excess stock quickly, but think about your own life for a minute. If you know your absolute favorite brand is going to put everything on a 50% off clearance rack in 3 weeks, do you ever buy it at full price? Absolutely not. You wait. This conditions consumers to wait for sales, which destroys the retailer's pricing power entirely. A localized inventory problem doesn't just ruin one financial quarter, it gradually reshapes long-term customer purchasing behavior, silently sabotaging the billion-dollar business model from the inside out.
Section 6. Speed versus accuracy. This whole situation brings the narrative to its ultimate strategic dilemma, tying our entire explainer together. The fast fashion model creates enormous operational complexity, forcing a brutal balancing act. If a company decides to produce cautiously to avoid overstocking and protect their warehouses, well, the inherent risk is that they miss out on massive sales opportunities when a trend suddenly goes viral and they literally have nothing to sell. But if they produce aggressively to ensure total availability and trend responsiveness, they run headfirst into the risk of that sudden excess inventory buildup. And remember, in global retail, a tiny 1% forecasting error on a headquarters spreadsheet multiplies across thousands of international markets. We are talking hundreds of millions of dollars of lost capital.
Let's look at this quote. Operational speed alone does not guarantee forecasting accuracy. Really let that sink in for a moment. You can have the absolute fastest supply chain in the entire world. You can charter the quickest cargo ships and run the most brilliantly optimized automated warehouses ever built by human hands. But moving incredibly fast means absolutely zero if you are running in the wrong direction. Balancing lightning-fast trend responsiveness with ironclad inventory discipline is the true, hidden secret to survival in this business. So I want to leave you with this final, somewhat provocative thought. The next time you see a massive clothing display stretching across a mall, or you're flipping through a clearance rack, ask yourself, is the secret to fast fashion actually producing the best trends, or is it simply predicting the right ones? Because it turns out, success isn't just about making trendy clothes at a global scale. It's an invisible war of predicting human demand accurately enough to keep speed, inventory, and profitability from totally destroying each other. Thanks so much for joining me on this explainer, and I will catch you all next time.